Listen up, folks. In the world of investing, knowledge is power. So what exactly is a market trend? Put simply, it's the overall direction that a market or security is moving in. Think of it like a wave. Is it going up, down, or just kind of bobbing around? Knowing the direction of the wave is essential for both traders and investors. Why? Because it helps us make informed decisions about when to buy, when to sell, and when to sit tight. If you're trying to surf, you don't want to paddle against the current, right? The same goes for investing. Riding with the trend can potentially lead to bigger gains, while fighting against it can result in losses. Understanding trends is like having a compass that can help you navigate the choppy waters of the market. So whether you're a seasoned pro or just starting out, buckle up and get ready to learn about market trends. Let's dive in. All right, now that we know why trends matter, let's talk about the different types of trends you'll encounter in the market. There are three basic types: uptrends, downtrends, and sideways trends. First up, we have the uptrend. This is what we all dream about, a market that's moving higher over time. An uptrend is characterized by higher highs and higher lows. Think of it like climbing a staircase. Next, we have the downtrend, which is the opposite of an uptrend. This is when the market is moving lower over time, making lower lows and lower highs. It's like going down a slide. Each dip takes you further down. Finally, we have the sideways trend, also known as a range-bound market. This is when the market isn't really going anywhere. It's just kind of bouncing around between a support level and a resistance level. Think of it like a ping pong ball. It's moving back and forth, but it's not making any real progress. Understanding these three basic trend types is crucial for any investor. It allows you to identify the overall market direction and make more informed decisions about your portfolio. Okay, so we've talked about what market trends are and the different types. Now let's dig a little deeper and explore what causes these trends to form in the first place. One of the biggest drivers of market trends is the economy. When the economy is strong, businesses are booming, people are spending, and the stock market tends to reflect that optimism. On the other hand, when the economy weakens, we often see a corresponding decline in the markets. But it's not just about cold, hard economic data. Investor psychology plays a huge role in shaping market trends too. Fear and greed are powerful emotions, and they can have a big impact on how investors behave. When investors are feeling bullish and confident, they tend to buy more, which can push prices higher. Conversely, when fear takes hold, investors may sell their holdings, driving prices down. Another factor that contributes to market trends is market cycles. These are patterns of market behavior that tend to repeat over time. By understanding the interplay between economic forces, investor psychology, and market cycles, we can gain a deeper understanding of why markets move the way they do. Section 4, Charting Your Course, Tools for Trend Analysis. All right, so we know what market trends are, why they matter, and what causes them. Now let's talk about how to actually identify and analyze these trends. One of the most important tools for trend analysis is technical analysis, which involves studying charts and using indicators to identify patterns and trends. One of the most basic tools in technical analysis is the trend line. You simply draw a line connecting the lows in an uptrend or the highs in a downtrend. These lines act as support and resistance levels, helping you visualize the direction of the trend. In addition to trendlines, there are a plethora of technical indicators that can help you identify trends and potential trading opportunities. Some popular indicators include moving averages, which smooth out price data to reveal the underlying trend, and the Relative Strength Index, or RSI, which can help identify overbought or oversold conditions. Another useful tool for trend analysis is chart patterns. These are recurring formations in price charts that can signal potential trend reversals or continuations. By learning how to use these tools effectively, you can gain a significant edge in the market. Section 5. Time is money. The impact of different time frames. Now let's talk about time frames, because when it comes to trend analysis, the time frame you choose to look at can make a big difference. What looks like a trend on a short-term chart might be just a blip on a long-term chart. For example, if you're a day trader, you might focus on intraday charts, looking at price movements over minutes or hours. On the other hand, if you're a long-term investor, you're probably more interested in monthly or yearly charts to get a sense of the overall market direction. The key is to choose a time frame that aligns with your investment goals and trading style. If you're constantly switching between time frames, you're likely to get whipsawed by the market's short-term fluctuations. And just like any good roadmap, it's important to choose the right scale for your journey.